Hello and welcome to Insights from the PM's Desk. I'm Justin Plouffe, Deputy Chief Investment Officer for Global Credit at Carlyle. So we're now officially in the second half of 2024, and it's time to check in on where we stand from a macroeconomic environment and what that means for the private credit markets. Starting with interest rates, we find ourselves in a higher for longer environment. Market consensus is now that rates will remain above 5% through the end of the year, above 4% at the end of 25, and above 3% thereafter. That's a marked difference from where we were just 18 months ago. Why is that? Well, inflation's come down, but it's been stickier than we thought, and it's been hard for the Fed to get us to that 2% target rate. In fact, today, we think it's going to take almost 20 months for the Fed to get to that target level. Moving to the real economy, our proprietary data at Carlyle shows that consumers are still spending largely on travel, tourism, and entertainment. This has provided a positive GDP backdrop for the U.S. Now, the story isn't all rosy for the consumer. We are seeing credit card delinquencies move up, something we're going to watch very closely in the second half of 2024. But of course, those long-term fixed-rate mortgages still provide a lot of support to U.S. consumer balance sheets. Now, in corporate spending, the vast majority of money is going to industrial spending, mostly into data centers and power generation. This is allowing companies to increase profits without necessarily increasing headcount. Now, the jobs picture really depends on what part of the economy you're in. If you're in software, where perhaps the greatest impact from AI has been seen, then the outlook is difficult. Again, with consumers spending so much on travel and tourism, hospitality continues to be a very strong job market. So what does all this mean for the private credit markets? Well, first of all, we've seen a convergence of spreads between the private direct lending market and the broadly syndicated market. If you look at the dot plot on the right, the return that you can get for investing in these two markets is now close to the same, a huge difference from where we were just a year ago. If we look at direct lending in particular, we've seen 100 to 150 basis points of tightening. Again, a significant move from the second half of last year. Despite this spread tightening, yields actually remain relatively attractive versus the last decade. We're still making equity-like returns for credit-like risk, and we still are constructive on the environment for putting money to work in private credit. Good news for our markets in 2024, we've seen a significant uptick in deal activity. And while much of it has been refinancing, that's often the canary in the coal mine before we see significant new M&A activity, which we do expect in the second half of the year. From a credit perspective, default rates have also remained muted at or below historical levels, a far cry from some of the predictions that people had in 2023. Now, there is an asterisk to that, which is that many more companies are doing restructurings out of court in a way that doesn't show up as a default. If you add in those out-of-court restructurings, the number of defaults goes from about 2% to 4%, so much more in line with long-term historical averages. Now, again, some good news. Because the capital markets have opened so significantly in the first half of the year, the distressed ratio and the trend line for defaults is going down. We're actually very constructive on the credit environment for the second half of 2024. Where do we see distressed? Well, it really continues to be concentrated in two separate areas, software and healthcare. This is where we're spending the vast majority of our time as we try to protect our downside in the more troubled parts of the portfolio. So as we head into the second half of 2024, we continue to find ourselves in a higher for longer environment, which benefits private credit yields. The consumer remains strong, and that means that the U.S. economy has actually been surprisingly resilient. In the second half of the year, we expect deal activity to pick up, and that it will be an excellent time to deploy capital in the world of private credit. Thanks so much for tuning in to Insights from the PM's Desk. We'll see you next time.